Money feels permanent because it is familiar. It appears stable because it is counted. It feels reliable because it can be measured. Most people assume money is what holds society together. If money works, life continues. If money fails, everything stops. This belief feels reasonable. It feels reinforced by routine, but it is incorrect. Money has failed many times. Societies have not. Trade continued. Authority persisted. Power reorganized. The world did not end when money stopped working. Something else carried it forward, less visible, rarely named, and usually ignored. So the real question is not what happens when money fails. The real question is what continues to function without it. Money is not value. Money is often described as value, but it is not. Money is agreement. It works only as long as others accept it as completion. When acceptance weakens, money does not slowly decline. It detaches. This distinction remains hidden in calm systems. Only under strain does the deeper structure appear, and when it does, it reveals that money was never the foundation. In early exchange, settlement was immediate. A good changed hands. Payment happened. The transaction ended. There was no delay and no institution. Money and settlement were the same moment. If money failed, exchange stopped instantly. There was no buffer. As systems expanded, the simplicity disappeared. Trade crossed distance, time entered transactions. Promises replaced immediacy. A transaction no longer ended when goods moved. It ended when obligations were recognized as complete. This created a new problem: who decides when completion occurs? Systems changed quietly, not to protect money, to protect continuity. Settlement, the hidden core. Settlement is not payment. Settlement is recognition. It is the moment the system agrees that an obligation is complete, postponed, or transformed. Payment is a method. Settlement is authority. When systems are calm, the difference is invisible. When systems strain, the difference becomes decisive. This becomes important later. France and anchored paper. In late 18th century France, political authority shifted rapidly. The monarchy collapsed. Church property was seized. New institutions took control. To stabilize the economy, a new currency was introduced. In theory, it was anchored to real property, confiscated land, tangible assets. The design appeared rational. Paper would represent land. Land would preserve value. Confidence would follow structure. The system did not fail because of intention. It failed because of incentives. Once issuance began, restraint disappeared. Each new note weakened the last. Prices adjusted quickly. Wages did not. This was not unique to France. It was structural. Farmers did not stop producing food. They stopped accepting paper. They did not withdraw from trade. They withdrew from settlement. Silver was accepted. Goods were accepted. Assignats were not. In cities, shortages appeared not because food vanished, but because agreement collapsed. The government could issue currency. It could not enforce belief. When settlement fails, value does not erode. It disconnects. The repeat pattern. This pattern did not end in France. It appeared wherever trust stretched beyond structure. 2 centuries later, the same mechanics surfaced in Asia. Several economies expanded rapidly using debt denominated in foreign units. Growth was strong. Confidence was high. Exchange rates appeared stable. The system worked as long as conversion held. When it failed, adjustment was immediate. Debts denominated externally expanded overnight. Balance sheets inverted. Confidence migrated outward. Capital did not disappear. It moved. Currencies weakened in sequence, not because production stopped, but because settlement rules changed. Those holding local obligations absorbed the loss. Those holding global claims did not. Savings lost meaning. Wages failed to adjust. Debts remained fixed. Assistance arrived later, and it arrived conditionally. Assets changed hands at reduced prices. Ownership consolidated. What appeared as collapse functioned as transfer. When banks do not fail in modern crises, banks rarely collapse outright. They narrow. Deposits are not confiscated. They are reclassified. Balances remain visible. Settlement is postponed. Currency values adjust downward. Obligations do not. What many believed they owned often functions instead as an unsecured claim. The system does not disappear. It tightens. This is not failure. It is prioritization. At this point, one truth becomes unavoidable. Money is not the stabilizer. Settlement is. Who is allowed to delay payment? Most people believe payment is a rule. You work, you pay, you settle. If you cannot pay, consequences follow. This belief feels universal. It feels fair, but it is not evenly applied. In every financial system, some actors are allowed to delay payment, others are not. Payment is not settlement. Settlement is recognition. Payment is a method. Settlement is authority. When systems strain, this difference decides outcomes. Time as the real currency in financial systems. Time is more valuable than money. The ability to delay payment is the ability to survive stress. Time allows adjustment. Time allows restructuring. Time allows errors to be absorbed. Without time, even small shocks become fatal. Households exist at the edge of settlement. Wages are fixed. Rent is due. Loans demand regular payment. Delay is treated as failure. This is not cruelty. It is design. Institutions operate differently. They refinance. They roll obligations forward. Missed payments become negotiations. This is not favoritism, it is capacity. At the top sit central institutions. Their obligations are extended, absorbed, or reclassified. Losses are postponed across time. Systems cannot function if the largest obligations settle immediately, so they do not. This is hierarchy. Why institutions outlive currency? Institutions feel permanent in a way money does not. Currencies change names. Units lose value. Symbols are replaced. Institutions remain. They survive revolutions, defaults, inflations, and reforms. This is not coincidence, it is design. Institutions are not built to preserve value. They are built to preserve order. Value is secondary. Continuity is primary. Currency requires belief. Institutions require compliance. Belief fades quickly. Compliance fades slowly. Institutions manage three things above all else: records, rules, and access. Currency is only one tool among many. When it fails, the others remain. Records, rules, access. Records allow obligations to persist beyond money. Balances are redenominated. Claims are reclassified. Debts are rewritten. The institution does not need money to remember who owes whom. It needs authority. Rules allow settlement to be redefined. Which obligations must settle now? Which can be postponed? Which can be transformed? These decisions are procedural, not rhetorical. Access determines who remains inside the system. When currency fails, access matters more than ownership. Those inside continue. Those outside experience collapse. Inflation, default, and compression. Inflation does not destroy institutions, it simplifies them. Defaults do not end systems, they rewrite obligations. Even hyperinflation does not eliminate administration. Cash disappears, rationing appears, control intensifies. This is often described as collapse. It is compression. The system sheds complexity to preserve itself. Transitions and conversions. During currency transitions, institutions decide exchange rates, carryovers, exclusions, which claims survive, which do not. This is not neutral, but it is consistent. New currencies fail without institutional depth. Competing units can circulate, they cannot govern. At the center of every surviving institution is control over settlement, not payment. Settlement, misreading, failure. When people say the system failed, they usually mean expectations failed. The system behaved as designed. It preserved continuity, hierarchy, and control. Durability is not morality. Money hides hierarchy by appearing neutral. When money strains, hierarchy emerges, not through speeches, through procedures. What actually survives? Across centuries, the pattern remains unchanged. Paper instruments fail. Obligations persist. Control concentrates. Those who rely on acceptance suffer first. Those who control settlement endure. This is not conspiracy, it is structure. If money is not the foundation of stability and trust survives its failure, then stability comes from somewhere else. Not from currency, not from price, but from the rules that decide which obligations remain valid. The open question: those rules are mostly invisible. They appear only under pressure, and they do not apply equally. The next question is not what money is worth. The next question is not who has money. The next question is who controls settlement when money is no longer enough. Because that is where power actually resides, and that is where this continues.